Hey everyone, welcome to this video where we are going to be talking about some pretty exciting, pretty interesting corporate finance stuff. We are going to be looking at IPOs, initial public offerings. What are IPOs? Why do companies do initial public offerings? How are companies listed on the stock exchange? We will consider a live example of Facebook when in 2012 when Facebook went public. So Facebook got listed on a stock exchange. It raised billions of dollars. It was the biggest tech IPO of that time. So we're going to consider the live example of Facebook of how they did it, what were the different terms in their prospectus. What is a prospectus if you don't know, right? A lot of you would know it, but for people who don't know, I'm assuming to make a video which is very beginner friendly. So if you know a lot of stuff, you can either skip it or you can send it to someone who would like to know all of this stuff but they don't know it, right? So with that said, let's actually dive into it because I don't want to make this like too long. Max should be like 15-20 minutes. So let's dive into it and let's start. Let's start from here. So I call it raising equity capital. If you don't know what equity capital is, there are different types of capital you can raise as a company. So there is debt capital and then there is equity capital. Equity capital is when you actually sell a part of your company and you give ownership to someone else, right? So let's say a big company like Facebook, and let's say it is owned by the then even now CEO, but let's say it is owned by Mark Zuckerberg, 100% of the company. But if Mark Zuckerberg wants to raise money from outside, he actually gives 10% of his company to outside investors, and then in return he gets investment. That is where you get equity capital from, right? So it's not just selling your company in an IPO, but it could also be selling your company to angel investors or private investors, right? So you don't necessarily have to go to the public markets and get your company listed on the stock exchange. But in this case, Facebook got listed on the stock exchange, and that is what we call an initial public offering, the first time when the company goes and lists itself on the stock exchange. How did it do that? Who were the people involved? Let's look into that now. Here is just a comparison of 2004 Facebook and 2023 Facebook in terms of their mission statement. I don't think it is extremely important, but it does give you a hint of how the company has evolved when it was founded in 2004, when it was Facebook helps you connect and share with people in your life. So it just helps you connect with people in your life. But now when it has evolved like 20 years down the line, and has changed its name, of course. The mission is now to give people the power to build a community and bring the world closer together. And the difference between this is massive. Anyways, let's get to IPOs. So, as I told you, initial public offering is the first time when a company is going public. But what do you mean a company goes public, right? So, lately, a lot of companies are going public, but what does it actually mean? I know that when a company goes public, they are listed on the stock exchange, right? People can buy and sell and trade in the company. But what happens behind the scenes? There are different types of IPOs and different types of offerings which a company can choose from. So let's talk about best efforts and firm commitment. What is a best efforts IPO? So in a best efforts IPO, if you read here, the underwriter does not guarantee anything. So the underwriter is going to do their best effort to sell your company to the public, and they're not guaranteeing whether it will happen or not, right? So usually these IPOs have a clause which is called all or none, which means either you want to sell 10% of your company. So either you're going to sell all of this 10%, or if you're selling 9.9, you basically terminate the deal. So you're not going public. So if you want to do it, you either do it all or you do it none. So that's called the best effort IPO, where the underwriter, who is the underwriter, by the way? So I will also talk about who is the underwriter in the next slide, but the underwriter is not giving you a firm commitment. But when you come to a firm commitment IPO, this is where the underwriter will actually guarantee you that we are going to sell this IPO, right? So they guarantee you that no matter what happens, if you want to sell 10% of your company, we can't sell 10% and just 9.5% is being sold. The remaining shares which are not sold, the underwriter buys it themselves. So no matter what, in a firm commitment IPO, the company always knows that it will sell out all its shares. So a lot of companies go with the firm commitment because if an IPO fails, it is not good on the company's image. So usually companies hire underwriters who make sure that the IPO shares are being sold to the public. There are Within an IPO, there are two types of shares. There is a primary and a secondary share offering. So, what does it mean when I'm saying Facebook went public and it issued primary shares? Or when I say Facebook went public and it issued secondary shares. So, when you're issuing primary shares, it's basically the company is issuing new shares, right? But when we're talking about secondary shares, we're talking about existing shares being sold by the insiders of the company. So let's say if Facebook goes to an IPO and the shares which are being sold by Mark Zuckerberg, who is the CEO. Let's say the CFO of Facebook is also selling some shares. This is called a secondary offering, where the insiders of the company are selling the shares to the public. Primary is when the insiders will not sell, but the company is issuing new stock or new shares for the public. But more often than not, you will see the third type of offering, which is hybrid offering. As the name suggests, it is a mix of primary and secondary. So some insiders are also going to sell the shares, but also the company is going to issue new shares to the public. So it's a hybrid offering. So we know what is a best efforts IPO, we know the firm commitment IPO, and we know primary and secondary. Let's talk about auction IPO. This is I wouldn't dive into more detail, but the basic idea of auction IPO is that the underwriters, they do not tell you a price, they tell you a range basically, and then the public basically is bidding on the price and the quantity they are willing to buy. And based on the biddings which Facebook will receive of how much quantity this investor is willing to buy at what price, they will actually check at what price it makes sense to basically price the IPO so that all the shares can sell out, right? So that is what an auction is. Moving ahead to underwriters. So who are underwriters, right? So if you see here in the next slide, these are the companies which are industry leading underwriters, right? So Goldman Sachs, UBS, Barclays, BofA, all of these are industry leading underwriters. And as you know, they are all investment banks. So the first thing, who are underwriters? Financial institutions and usually an investment bank, right? So more often than not, every underwriter for an IPO would be an investment bank. Not more often than not, it's 100% of the time. So underwriters are usually investment banks, big investment banks, who usually advise the company in raising capital. So connecting it to our Facebook IPO, underwriters were the investment banks that were advising the company, Facebook, on how much money to raise, what should be the price of your IPO, and they also help the company in managing the risk. They help the company in filing all the legal documents. For example, here I will actually put a link for this prospectus in the description, so feel free to check it out. Of course, it's like a very big fucking document, so you don't have to read it, but the first page is always interesting. So this is the IPO of Facebook. So basically, if you want to go public, there are a lot of legal documents and all that stuff you need to take care. So underwriters are going to help you with that. Who are the underwriters of the Facebook IPO? Very interesting stuff. So underwriters are always on the first page of any IPO prospectus. Prospectus is the document which the company needs to issue to the public, so that the public knows what this company does, what are the financials of the company, why you should invest in this company, what are the risks of investing in this company. Everything is being shared in the IPO prospectus. Here you can see how many shares Facebook wanted to issue. This is from 2012. Facebook wanted to issue 421 million shares, right? This is the price of the IPO. If you see per share price, this is $38. If you see the names of some of the biggest underwriters here, Morgan Stanley, BofA Maryland, Citigroup, we have Goldman Sachs, we have JP Morgan. So all of these underwriters were helping this company, this tech company, Facebook, to raise money from the markets. Now, the question, why are there so many underwriters, right? We just said underwriter is an investment bank who is helping the company to raise money and selling the stock. Coming to the next point, underwriters are here, syndicate is here. Syndicate is basically a group of underwriters who work together on one single IPO, right? So if you see why there's so many underwriters, this is because these are syndicate. This is a syndicate of underwriters. And in this syndicate, we have a lead underwriter. So this is basically the boss underwriter, right? So they are actually the book running manager. They are the biggest underwriter, or in terms of they are taking the biggest risk, and they are managing the whole syndicate. And in Facebook's case, the lead underwriter was actually Morgan Stanley, and as you can see, it is mentioned in the first, and it is basically in a bigger font compared to others, and that is unusual IPO prospectus norm, right? So the lead underwriter usually is in a bigger character. I don't know if it's still the case, but I believe it is. And yeah, that's how it is. So you know what it is: an underwriter, an investment bank that is helping the company to raise money and selling stock. Syndicate is basically the same thing, but just a group of them. Coming next is, I already showed you who are the leading underwriters. There's something called Greenshoe option. I think this video is going to be big, but yeah, let's do it. I think I can even do it in different parts. Yeah, I'll actually upload 2 different parts of this. So Greenshoe option is an option when underwriters, so if you read it from here, it is an option for underwriters to sell more shares than agreed in IPO. What does this mean here? I am the underwriter, I am advising Facebook. What does it mean I can sell more shares than agreed? So as I showed you this prospectus, I showed you how many shares Facebook wants to sell. Facebook wants to sell 421 million shares. Does it mean that underwriter, so all of these people who are the underwriters, can they sell more than 421 million shares to the public now? Yes, exactly. That is what a Greenshoe option is. If you see, the details about Greenshoe option is also given in the prospectus. So it should be somewhere here, exactly here. If you read this part, we and selling stockholders have granted the underwriters, so we have granted the underwriters the right to purchase up to an additional 63 million shares of Class A common stock to cover over allotments. Notice what does it say? Here it is 421 million shares which Facebook wants to issue, and here they have given a line that the stockholders and have granted the underwriters the right to purchase an additional 63 million shares to cover over allotments. And this is exactly what I talked about when I said that it is the right of the underwriter to sell more stock than agreed. Why does this happen? This happens because the demand for the IPO is high. So let's say it is the listing day for Facebook and the demand is very high. So you already sold 421 million shares, but the demand is so high. So you have the option as an underwriter. This needs to be agreed upon before the IPO, right? So you have the option to sell even more shares, 63 million more shares. Now, how does it work? It's like a thing of its own. If you would like a video on that, then I would love to make it, because I spent a lot of time understanding how Greenshoe option works in a real-time basis. Then let's go to the next one, and basically why it is done, as I told you, because the demand is high. It is also known as over allotment option, because you have a set of shares, but other than selling all of this, you can sell additional shares. So you agreed on this much, but you're selling more than this, so you're selling additional shares. So this is over allotting the shares. So this is why it is called over allotment. Sometimes instead of Greenshoe option, it is also called over allotment. And if you read here, what does it say? Here it says over allotment. So that basically means Greenshoe option. And usually this helps both the company and the underwriter. It helps in stabilizing the price. If the demand is too high, the price is going to be too high. So this is where, you know, selling additional shares will help you stabilize the price mechanism, etc. Next, now let's start Facebook IPO, and I'll run through this because I'm seeing the time here and it's been 10 minutes, and it has been 10 minutes since I started tracking it. So I'm pretty sure I spent another 5 minutes before that where I was not tracking the time. So here, this is a chart where Facebook listed in 2012, and until last year 2022 we have a good chart. You can pause this video, look at it if you like. Underwriting spread. So let me take you to the prospectus. Here. So in the prospectus, you have price to the public, you have uh, underwriting discount, you have proceeds to Facebook. Now, what does this mean? I have actually taken all those three here, so you can look at it here. What does this mean? If I take you back for a second to the types of IPOs, Facebook is a firm commitment IPO. A firm commitment IPO is an IPO where the underwriter will guarantee you that the issue is going to be sold. How can an underwriter guarantee? Why can they take this risk? The reason why an underwriter will take this risk is, read here. The underwriter purchases the entire issue from Facebook at a discount. And then the underwriter goes to the market and sells it at a premium. And premium is basically the IPO price. So in the case of Facebook, ladies and gentlemen, this is the price to the public, $38. Proceeds to Facebook. This is the price at which the underwriters purchase the entire stock from Facebook. So you see, they purchase at 37.58 and they sell at 38. So the difference, which is called underwriting discount and commission, this difference is basically called the underwriting spread. So the underwriting spread is nothing but the price to public minus price to company. So you purchase at a discount from the company and sell it to the public, and that's how you can guarantee that all the stocks will be sold, right? That's why you are ready to take the risk. If all stocks are not sold, then of course you are in losses, but if you want to take that guarantee and take that risk, then you need some money to be made, right? So that's how you make that money. And what is the spread? So there is something called underwriting spread. This is 1.1%, and you can see the formula how I got it. I just divided this by this, right? Divided this by the IPO price, basically. Here, 38. What do you think about this spread? Is it big? Is it small? Is it too much? By the way, how much would that be? For information, is going to be here. So 0.418 into the total shares which Facebook is issuing, that is 421 million. It's gonna be 76 million, and this is basically the fees. This is the commission which the underwriters take, right? So that's 176 million in fees just to the underwriters. That's the discount they are gonna make. This spread is basically not the industry standard. The industry standard, even today on Wall Street, the industry standard is 4 to 7, 3.5 to 7, 7.5%. So why was Facebook's underwriting fees so low, just 1% of the price to public? The reason is it was the biggest IPO of that time. In 2012, it raised $16 billion. It was the biggest IPO. So obviously, even if you're taking a smaller spread on such a big size, you make good money. The other reason was this was the hottest IPO and a lot of competition between underwriters to be the lead underwriter, because obviously Morgan Stanley was the lead underwriter. So people care about Morgan Stanley more than they would care about other underwriters, because the lead underwriter takes the most responsibility. So underwriting competition was very high. So the underwriting companies, the investment banks were ready to, take a smaller spread and be the lead underwriter. And then, as I mentioned, it was the largest tech IPO of the time. So it had its own leverage against the underwriters. Primary versus secondary shares. This one is interesting because I use ChatGPT here. You can go and search how many primary and secondary shares were there. Primary shares are those shares which are newly issued. Secondary shares are those shares which are being sold by the insiders of the company during an IPO. In the case of Facebook, there were no secondary shares. All of the shares which were issued in the Facebook IPO were primary shares. If you want to read this, pause the video and read it, but it just says that all the shares were primary shares. So everything which was issued in the Facebook IPO was basically newly issued. Let's move to the Greenshoe provision. As we saw in the IPO prospectus, we know what was the Greenshoe provision. As I explained, what is the Greenshoe provision? Now, checking it with Facebook, we know that there were 63 million shares which were basically allowed to be over allotted. And if you just check what is the percentage of 63 million shares out of the total issue size of 400 million, that would be 15%, right? So 15% was the Greenshoe option. first day performance. What do you think about the biggest IPO of 2012 and that decade? How did it perform on the opening day? Well, on the first day, Facebook failed to perform as investors were expecting it to be the best IPO. They were expecting it to basically list at a 5 to 10% premium or close at a 5 to 10% upper boundary from the listing price. It did not happen. It opened at 42. Well, the IP price is 38. When you go on the stock exchange, based on the demand and supply, you can actually debut at a little higher or lower price. Based on that, it debuted on 42. But then if you see the IP price was 38, it closed the day on 38, roughly the same. So there were no returns on the first day, while people were expecting it to be higher trading on the first day itself, though it did not happen. So even though it was the biggest IPO of that time, it was also a flop IPO, which many analysts and many Wall Street people believe. Here is also a chart which explains the median tech IPO performance on the first day, and it's like 21% positive performance. Comparing it to Facebook, it was not even, not even. Just understand, it's not even like 2% of it or 1% of this stuff. So median one day performance is 21%. After 3 months, if you would have checked, that's the performance of Facebook. After 3 months, the closing price was 19.5, right? So if you check Facebook price on August 2012, well, we can actually go to investing.com and you can either go in the chart, or let's say I want to just check from here what was the price of Facebook 2012, and you can just search for your price, whichever price you're looking for. From here I'll just apply. Oh well, I messed up. It's not supposed to be this. (2012) August. Here. Okay, apply. Okay, pretty weird. I'm not able to do it because oh yeah, got it. But we need to go down, so we can go to August. Here, that's August, right? June, July, August. That should be the 8th month, and that should be here. And here is the price on 17th August. The price was 19.5. That's the price, right? So as I mentioned here, 19.5. And 3 months before, on the IPO date, it was 38.23. So if you see the absolute return, which is basically nothing but, if we calculate something called 19.5, 38.23, calculating the absolute return would basically be what's the difference between this, and then this is the difference by the initial price, which is 38.23, and check the percentage. That's 50%. That's the 50% negative return which Facebook gave in 3 months. But this is not always the best way to look at it. So we actually analyze this return, and we use an annualized return formula. And regarding annualized return, we are going to be talking about it in the next slide as well. So let's deal with annualized return in the next slide and move ahead. Here, so Microsoft was one of the early investors in Facebook. So if you see, this is from 2007. So Microsoft actually invested 240 million in Facebook in 2007. So let's talk about how much shares did Microsoft get and what was their investment worth at the time of the IPO. So investment made, as I showed you in the previous slide, was 240 million. And how many shares was Microsoft allotted? So you can actually look it up in the prospectus if you want. There should be a column, yeah, a table where you have to disclose all your existing investors and the number of shares they have. So if you see Microsoft Corporation, they have 32 million shares, right? So and if you talk about the ownership, they have 1.8% ownership of the company. And here they have number of shares being offered. So how many shares are they offering in the IPO? But wait, is ChatGPT wrong? Because ChatGPT told me that there was no secondary shares offered, there were only primary shares. But if an insider is selling, it means there were secondary shares. So we have to check that. So I'm pretty sure there were secondary shares. I have to check that. I'll probably put the correction in the comment section of this video. Because this makes sense. Because if the insiders are selling, if Mark Zuckerberg, if he is selling his shares, number of shares being offered, then that means there were secondary shares offered in this IPO. So we got to check that. But coming back to Microsoft, so Microsoft had these many shares, the investment was this much, the price per share. So we can just multiply or divide their investment by the number of shares they had, which is these many. And that's the price per share. So 7.32 was the price per share for Microsoft's investment. And when the company went for IPO, the IPO price was 38. So looking at that, what was the return Microsoft? What was the annualized return which Microsoft made, right? So here is the question. What was the price? 7.32. So 7.32, let's say this was the price per share for Microsoft in 2007 when they invested, and 2012 when the company went public, the price was 38, right? So how much time is this? 2012 minus 2007, this is 5 years. So within 5 years, if you are to check the absolute return which Microsoft made, Alt HUI here. So how are you going to check the absolute return? You're going to check what is the difference, and then you're going to basically divide that difference with the initial value. The initial value was 7.32, and Alt H and P, this is the percentage. So Microsoft made an absolute return of 409%, but this is not always the best way to look at it. We need to look at the annualized return, because the annualized return, so here are some technicals now of corporate finance, right? Because the annualized return will consider the period of your holding, right? So this was the holding period. Let's say if Microsoft sells it, right? We don't know if Microsoft sold all of it. It did not, certainly. But you look at annualized return instead of absolute return. This is the absolute return, because annualized return takes into effect the compounding period, the holding period, and it gives you a truer picture of understanding the returns. So there are two methods. This is one formula, right? So I actually put the numbers as well, so you can see if you do this formula, you're going to get the annualized return of 39.1%. What is this formula? Let's try it. Ending value 38, beginning value 7.32. So this is the ending value, right? 38. Let me put the brackets though. Ending value by the beginning value in 2007, right? You have to raise this to 1 by the holding period, which is 5 years, minus 1. Alt H and P here, 39.1%, right? So that's the formula for annualized return, and this gives you a truer picture rather than 400%, right? Obviously 400% is correct based on absolute return from what you bought, what you sold, that's your return. But annualized return is basically throughout the years what was the return you were compounding. So that was the CAGR. Coming next is another way of calculating the same thing, which is your initial value, which is 7.32, initial value of your share price, plus the gains or losses. So this is the gain or loss, right? As I showed you. So if you subtract this, this is the gain or loss. So this is gain, of course. So let's use this formula now. This formula says you need to take your initial value plus the gain or loss, which is 38 minus 7.32. Then you need to basically divide it by the initial value, raise it to 1 by the holding period, minus 1. The formula isn't right. I missed something here. Yeah, I believe it should be here. Yeah, got it. So same thing, two methods, two formulas, different formulas. There's actually three, I don't know the third one. Two different formulas, two different, same answers for analyzed return. And for absolute return, there's just one formula, which is not the best way to look at investments. And if Microsoft sold all the shares, just multiply the number of shares they had with the IPO price, and that would be the money they would have made. And then here is a chart, which is a good infographic, which you can look at. Pause the video, screenshot it, or pause the video, look at it. Peter Thiel. He also made an investment. He's an angel investor. He invested in Facebook before the company went public, and his price per share was actually way better compared to Microsoft. He actually owned more than Microsoft. I think Microsoft owned 1.8%, but Peter actually owned about 2 or a little more than 2% of Facebook. And he just made 500,000 investment into the company, and he received 32 million shares. But there is a caveat here. So I'm considering the shares of Peter to be basically the shares of his company. So if you see here, there's his name, Peter, in the prospectus, and he has 44 million shares, but I'm considering just 32 because if you go to the notes, note number 16 here, so all of the 42 million shares for Peter, they consist of this investment, 32 million. Basically, this is the holding entity. Then there is another holding entity, which is the Founders Fund, which is basically the venture capital fund of Peter, where he invested this money into Facebook for other investors. And then there's another, the founders entity, which is holding other shares. So I'm just considering this amount, this number of shares to be which is held by this entity to be the shares which is held by Peter. Hence this calculation, right? So then you just check the price per share by dividing the investment made divided by the number of shares, and that is the price per share. And annualized return for Peter is going to be massive. So let's check. Here what we can do is basically just change these numbers. Peter invested, I don't know, when did Peter invest though? I'm not sure. Peter invested, let's say, in 2004. And his price per share is 0.015 to 0.0152. Yeah. So if you see, this is the initial value. This is the final value. The number of holding period is 8. In Microsoft it was 5, right? Because I changed this, right? So it changed here as well. I'm teaching Excel now, what the fuck? So never mind. If you just see how the formulas have changed, right? So the analyzed return, 165.91, method 1, 165.91, method 2. Both the methods, same analyzed return. He held it for 8 years. This is our assumption. And if you're looking at, now, this is fucking funny. If you're looking at the absolute return, it gives you a number which is hard to comprehend. It is 249,000%, 249,900%, 250,000%. So that is the reason why you're not supposed to look at absolute returns. Look at annualized return. It takes into consideration the compounding effect and the holding period, and that's the best way to look at investment returns. There are some other ways as well. If you're interested, then I can definitely make a video on that. Other than that, all the Q&As, feel free to shoot it in the comments. If you think I made a mistake, if you think I'm blabbering some BS and I wasn't right, feel free to correct me, because this is apparently a uni project of mine which I deeply enjoy and deeply love. Feel free to check my channel. I also talk about let's come here. I also talk about cryptocurrencies. I talk about leadership, personality, career development, studies. How do you build your career? What do you do to develop yourself? Self-development studies. So much stuff. So though I'm not a regular poster on YouTube, but I really enjoy this stuff. Feel free to check the channel. Feel free to subscribe. And yeah, see you in the next video when I feel like recording something. Bye bye.